In the last video, I walked you through 2 years on the barbell dial, looking at how 5 settings handled the 2008 crash and the 2009 recovery. Today, I'm running that same dial across every market cycle going back to 1958. 38 independent 30-year windows with and without contributions, every setting tested against every window in the historical record. 67 years of data says a dial doesn't make you pick between performance and protection. It lets you choose the trade. At the conservative end, you get index-like returns with the worst-case drawdown cut nearly in half. The middle of the dial beats 100% S&P 500 ETF SPY outright on both return and drawdown. And at the aggressive end, you greatly beat the index on return with drawdowns matching or exceeding 100% SPY in the worst events. If 100% in the S&P 500 is your idea of safe, the dial is the safer version of it. Let's get into it. 38 rolling 30-year windows starting in 1958 and running through 1995 starts. Every window covers a complete investor lifetime from accumulation through retirement. The historical record running through these windows includes the 1968 to 1982 stagflation, the 2000 dot-com bust, the 2008 financial crisis, and the 2022 dual crash with no events excluded. I tested every window with a $100,000 start and no contributions, and again with the same start plus $10,000 added every January for 30 years. CAGR barely moves between the two scenarios. What changes is the dollar gap between the settings, and it gets bigger when contributions are running on top. Quick orientation on the dial. Throughout this video, the first number is the Treasury sleeve, and the second number is the Leap sleeve. 75-25 means 75% treasuries and 25% leaps, and 50-50 means running half and half. The dial runs from 50-50 at the aggressive end through 80-20 at the conservative end in 5 percentage point increments. The portfolio rebalances every January. Leaps on SPY, the S&P 500 ETF, are bought at 10% in the money with about 2.5 years to expiration, then rolled annually. The bond sleeve runs a quarterly rotation between intermediate and short-term treasuries based on what the yield curve is doing, and that mechanic gets its own video next. If you're new here, the full plan and the earlier barbell videos are in the foundational flight plan in the playlist link below. Drawdowns are measured monthly, peak to trough. Every month inside every window gets a portfolio value. The running peak gets tracked, and the deepest dip a viewer would have seen on their account statement is what I'm reporting. I sorted the dial into 3 groups: the aggressive end, the middle, and the retirement end. I'll walk from most aggressive to most conservative, and for every setting, I'll show you how it performed in the worst 3 events the dial has ever been through. By name: stagflation, dot-com, and the financial crisis. At the aggressive end of the dial, you're trading deeper drawdown for meaningfully more compounding. The 50-50 setting is half treasuries and half leaps. Across 38 windows, it posted a medium CAGR of around 12.6%, roughly 210 basis points a year more than 100% SPY, which sat at around 10.5%. 210 basis points compounded over 30 years is real money. The cost shows up in drawdowns. Medium drawdown across all 38 windows was around 57%, 16 points deeper than the index. By event, 50-50 ran 62% in the Great Financial Crisis against the index's 49%, 57% in the dot-com bust against 41%, and 55% in stagflation against 39%. Across all 3 of the worst bear markets in modern history, 50-50 ran 13 to 16 percentage points deeper than the index. With a $100,000 start, the median 50-50 window finished at around $3.5 million without contributions and $6.1 million with $10,000 a year added every January, against the index's $2 million and $3.6 million. That's a setting for somebody who can stomach the volatility. If you can't sleep through that kind of drawdown, grinding on for 18 months, this isn't your setting. The 60-40 Treasury Leap setting sits 1 notch more conservative. Median CAGR is around 12.3% or 180 basis points above the S&P 500. Median drawdown is around 45%, basically the same as the index's 41%, with worst case events landing close to where the index lands. By event, 60-40 ran 49% in the Great Financial Crisis against the index's 49%, 45% in the dot-com bust against 41%, and 44% in stagflation against 39%. That's roughly index-level drawdown against all 3 big bear markets in this test. The 60-40 finishes at around $3.3 million without contributions and $5.7 million with contributions, against the index's $2 million and $3.6 million on the same starting capital. That's the leveraged version of the index, with the Treasury sleeve carrying the ballast. The middle of the dial is the performance sweet spot. Both 65-35 and 70-30 beat 100% S&P 500 on both fronts at the same time, with more return and less drawdown at every setting in this group. The 65-35 Treasury Leaps setting is 2/3 Treasury and 1/3 Leaps. Medium CAGR is around 12.1%. That's 161 basis points better than 100% S&P 500, with a median drawdown of around 38%, 3 points less than the index. By event, 65-35 took 43% in the Great Financial Crisis against the index's 49%, 38% in the dot-com bust against 41%, and 37% in stagflation against 39%. Against all three of the worst events in this test, 65-35 took less drawdown than the index while compounding meaningfully ahead of it. The reason this works is convexity. The Leap sleeve captures more equity upside than pure equity allocation of the same size because the options accelerate, while the Treasury sleeve cushions the downside in the events where pure equity gets hit hardest. You get more equity exposure on the way up and less on the way down, and that's the convexity sweet spot at 65-35. The 65-35 finishes at around $3.1 million without contributions and $5.4 million with contributions, roughly $1 million more than the index without contributions and around $1.7 million more with contributions on a setting that runs a smaller worst-case dip along the way. 70-30 is the same story with the dial set even more conservative. Median CAGR around 11.6%. That's 108 basis points above the index with a median drawdown of 31%. That's 10 points less than SPY. By event, 70-30 ran 36% in the Great Financial Crisis against the index's 49%, 31% in the dot-com bust against 41%, and 31% in stagflation against 39%. Every named bear market in this test, 70-30 took less pain than 100% SPY while compounding faster. The same convexity sweet spot at work in 65-35, just dialed one notch more conservative. The 70-30 finishes around $2.7 million without contributions and $4.8 million with contributions, about $700,000 and $1.1 million ahead of the index in each scenario. The retirement end of the dial is the safety surprise. This is where the test gave me the strongest finding and its cleanest result. The 75-25 Treasury Leap setting beat the S&P 500 on every dimension that matters. More CAGR, smaller median drawdown, smaller worst case in every named bear market in this test, and more money at the end with or without contributions. Across 38 windows, 75-25 posted a median CAGR of around 11.1%. That's 58 basis points above the index, with a median drawdown of around 26%, which is 15 points less than SPY. By event, 75-25 took 29% in the Great Financial Crisis against the index's 49%, which is 20 points less pain and the worst single event in modern history. The pattern held in the dot-com bust at 26% versus 41%, and in the stagflation period at 26% versus 39%. Across all the major bear markets in this test, the 75-25 cut the index's drawdown by half or close to it, while still posting more annual CAGR over the long run. The 75-25 finishes at around $2.4 million without contributions and $4.2 million with contributions, ahead of the index in both scenarios. That's a cleaner outcome than 100% SPY across the major bear markets in this test, with more money at the end. That's why it's the setting I'm planning to settle at when I hit retirement. 75-25 isn't only a retirement setting. Any conservative investor who wants to slightly beat the index without taking the deep drawdowns has a strong fit here. The 80-20 Treasury Leap setting is where the dial gets interesting. It's not designed to outperform the index. It's designed to give you index-like compounding with materially less pain. On CAGR, the 80-20 was basically tied with the index at 10.4% against 10.5%. Where the gap opened up was on drawdowns. 22% median for the 80-20 against 41% for the index, cut nearly in half with compounding holding up. By event, the cushion gets even sharper. In the Great Financial Crisis, the 80-20 took a 21% drawdown against the index's 49%. That's 28 percentage points less pain and the worst single event in modern history. The dot-com bust was even more lopsided, 14% versus 40% because rates dropped from over 6% to under 2% across those 3 years, and the bond sleeve rallied hard while the leaps got crushed. The bonds did the cushioning. In the 1973 and 1974 stagflation bear, the 80-20 held its drawdown to about 19% against the index's 39%. Across the 3 worst bear markets in this test, the 80-20 cut the index's drawdown roughly in half or better. Now, here's the part that surprised me when I ran the numbers. That 22% median I just quoted, it doesn't actually come from any of those three crises. It was the 1987 crash, the September to November sequence that included Black Monday in the middle of it. The S&P fell about 24% from peak to trough across those 3 months on monthly marks, with most of that compression happening in October and November. The 80-20 took a 22% drawdown across the same window. That's the worst single event for the strategy across the entire historical record. The takeaway is the structure. The 80-20's worst case is bounded around 22% across 67 years of stress events, including a sharp 3-month sequence with no bond cushion to soften it. The famous multi-year bears were all shallower than that ceiling. In dollar terms, the 80-20 finished at around $1.97 million without contributions, basically tied with the index at $2 million. With $10,000 per year in contributions added over 30 years, the 80-20 finished around $3.87 million against the index's $3.65 million, about $220,000 ahead. That's what bond cushioning at the highest level of the dial actually delivers. It doesn't just reduce drawdowns in the events you remember, it compresses the worst case tail across every major bear market on record, including the one most people forget. Here's what 67 years of testing actually buys you. When the S&P 500 goes up, this is what happens at each setting. In a continuous bull market like 2009 forward, where there was no real bear in 15 years, the aggressive end of the dial runs hot. 50-50 ran nearly 20% CAGR, 60-40 ran 17%, and 65-35 ran 15%, all well above the index's 13.6%. 70-30 tied the index almost to the basis point. The conservative end gave up some ground in pure bull markets with 75-25 around 12% and 80-20 around 10%. When the S&P 500 goes down, the dial flips with the conservative end protecting hard. 80-20 cuts the worst drawdown nearly in half against the index. 75-25 takes 15 points less drawdown, and 70-30 runs 10 points less. 65-35 still beats the index on drawdown by 3 points, while 60-40 sits roughly at index levels and 50-50 runs about 16 points deeper. The 100% SPY investor doesn't have a dial. They have one setting and they ride it for life, regardless of where they are in the journey or where the market is. The dial gives you a choice. That choice is a safer version of safe, and that's the so what. I'm 50, about 15 years from retirement. Right now I run 50-50 because I'm in my peak earning years and I can stomach the volatility. As I get into the back half of my career, probably the last 4 or 5 years before I retire, I'll glide down to 60-40, and by the time I hit retirement, I'll settle at 75-25 and stay there. Same engine, just a different setting at a different stage of life. So what you just saw is 67 years of compounding tested across the full dial. The dial works. The next stretch of videos in the playlist keeps building on it. Coming up, the bond rule I make every quarter, the account size needed to run each setting on the dial, and the hybrid 6% rule that brings the dial into retirement. The retirement test runs the same dial through 38 retirement windows with actual withdrawals on the back end. The question is whether the structure still holds when you're paying yourself every January for 30 years. The point isn't to predict better, it's to build a structure you can actually survive. Drop a comment with the dial setting that matches where you are right now. And if you sat at 50-50, would you actually hold through a 60% drawdown that grinds on for 18 months? Be honest with yourself. If this changed how you think about what safe actually means, hit the like button. If you want to follow my real retirement accounts and watch this strategy run in live conditions, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.